So when a buyer puts together a valuation or initial offer for a business, they first and foremost look at a number of different valuation techniques. It could be discounted cash flow, it could be looking at comparable company multiples of EBITDA, but ultimately they will come up with a valuation which we would call enterprise value, which is based on your profit generation. Once they have established an enterprise value, they will want to understand what liquidity there is in the business and what assets might be surplus to the day-to-day business running requirements. And to do that, they will look at your asset base. Fixed assets are relatively easy to value, providing they're well invested, but your net current assets, effectively your debtors less your creditors, plus your cash less any long-term interest-bearing debt, all do have a bearing on what surplus assets might be in the business that could be paid over and above the enterprise value that's been offered for your business. When the buyer establishes a sustainable level of EBITDA, it will want to know that there is a normal level of working capital in the business moving forward. That test is put in for two reasons. One, to make sure that once we've agreed price and we're going into due diligence, that the assets are not managed out of the ordinary course before completion, so they're making sure that the asset base remains broadly as it was at the point they put their offer in. And secondly, they want to make sure that there is enough working capital in the business at the point of completion to ensure liquidity is there and that it can continue to trade and the business can continue to meet its commitments. To do that, typically we strike a net working capital target. That can be done on a number of different ways. The most traditional, in my experience, is looking back over the last 12 months average working capital to establish a target. Let's say that target is £1 million for this example, and then in the month of completion they will look at your working capital again on the same basis, and if that working capital is higher or lower than the target set, there would be an adjustment to the purchase price. So if it was 1.1 million at completion, there'd be another 100,000 of value that could come to the seller. If it was 900,000, there'd be 100,000 reduction in the price. Once we've established the working capital target, we then need to look at your cash and your debt position. So cash is, as you might expect, fairly easily defined. Debt is typically things such as long-term loans, director loans, could be corporation tax, but it's typically interest bearing, could be invoice discounting. So you would then take a sum. So let's say you had 3 million of cash, you had £1 million of debt, and you had a £100,000 positive adjustment to working capital. That would give you 2.1 million on top of the enterprise value of your company.